Hello and welcome back. We're on for another episode of the StoneX Australian Cattle and Beef Market Report. My name is Ripley Atkinson and I'm the Australian Livestock and Commodities Manager for StoneX based in Sydney, where we're developing price risk management tools for the Australian beef industry to help the sector manage market and price volatility with our Australian cattle swap. We're brought to you by StoneX Group, a Nasdaq-listed global financial services network with 100 years of experience in global commodity markets. Remember that the trading of derivatives such as futures, options, and over-the-counter products or swaps may not be suitable for all investors. Derivatives trading involves substantial risk of loss, and you should fully understand the risks prior to trading. Past results are not necessarily indicative of future results. Good to be back. We're back for markets this week and the release on Wednesday of MLA's Beef Producer Intention Survey. A few things to kick us off. First 3 weeks of June, markets have been pretty delicately balanced, is the way I'd call them. I think they're in a sustainable position in the sense that there's money to be made for all parts of the supply chain, but they're starting to see some tension and some pressures in different parts of the supply chain in terms of profitability. I think the second thing, and I've done some thinking about this, in the past week or so, is some more structural changes around the implications of reallocation of feedlot space and also what a potential rebuild or at least retention of females, particularly cows, might mean for markets and spreads in the south. On MLA's Beef Producer Intention Survey, it was delayed a bit because of that late March rain and flooding in Queensland. Thoughts go out to those on the mid-north coast and, in Western Queensland recovering from those instances. But the data supports my view on the market and it supports my view on the cattle cycle. This does go against what some others are saying in the sector in terms of where we're looking and the cold hard numbers from the producers point to what I've been saying for most of this year. Starting with markets though, it's been quite interesting. You're starting to see a divergence across the three different categories at a high level. Your restockers, feeders and processors. The feeder jobs stayed relatively flat and I would call it stable. Grids haven't moved, on your Queensland crossbred cattle really at all. The Angus market's the Angus market, so I'm not going to jump into that, but that feeder job has remained relatively consistent. Looking at the restockers and thinking about, the past month or so, particularly in the last week to 10 days, that cold weather's really, kicked into gear and frosts have, come out in sort of full force. You look at the restocker job over the last month, it started to pull back a bit, and I think that effect of frost and cold weather slowing both cattle production and grass growth has been a good sort of indicator to seeing that market slide in the restockers, which is not uncommon. You come into winter, you get a frost and it really slows things up. I mean, not everything can be planted to oats. So that was something I have noticed, just looking at the data, and when you actually align that with some weather events, it's pretty telling. The slaughter cattle though have started to find some momentum, and I think the next couple of months will be quite interesting to watch. The slaughter job, particularly through winter, in my view, will be a focus area. The southern interest in northern markets, of course, but generally just as well, the availability of slaughter cattle through winter, particularly because the south sort of turns off, if you will, makes for quite an interesting space. And I think the slaughter cattle generally are undervalued and they've got more upside, through winter. The other thing I'd say about that restocker space is, regardless of season and how good it is or how bad it is, we've got to put the whole supply chain in perspective. And what I mean by that is the feeders at the other end, if we're focusing on a restock or animal heading into the feedlot, we've got to consider where the meat job or meat markets are at. So yes, the demand is strong, but that doesn't necessarily mean pricing is going to translate to higher offers from processors or exporters for fed cattle, which in turn affects the ability of feedlots to increase their grids to pay higher rates, for the cattle entering the feedlot. So that dynamic, when you combine, the factors right across the supply chain, I think is something important to consider. And I think the frosts, came at a pretty interesting time, because my view of that restocker market over the last month was it's probably be getting close to being overvalued, in the sense that we were moving into winter. It wasn't like we had all this rain and we're actually coming into our peak production time, spring and summer for a lot of places, particularly where the cattle are. And I just that's my view there with that restocker market, is it was probably getting a little bit too hot, particularly because we were going into winter, not coming out of it. And when you include the aspect of, fed cattle prices and meat prices, I'm not disputing the fact that the demand isn't strong for Australian product, but it doesn't necessarily mean that everyone's paying overs to clamber all over the market to access supply. There's plenty of supply out of Australia at the minute. And when you combine all of those factors, the lack of upside or fed prices grinding higher, the feeders are in a position where they can only go so far. And that sort of links to what I started with for this episode, was there is a bit of underlying tension at the minute in the feeder space. Particularly, I'm not looking at Angus cattle, but just more broadly, in the sense that profitability is in some instances becoming challenged, and producers aren't forced to sell, which is the positive. There's not that rush of cattle. We're not going to see that, at least through this winter anyway, or the dry season. That's a good thing, but you've really got to have all things align for the market to really see the upside across the board. The Angus job at the minute's seasonal and cyclical. We'll get to, mid to late winter, it'll find a peak and the Angus grids will come off. It's as sure as night turns to day. It's just a sort of standard occurrence. But my point around, tension in the underlying market is, if the meat prices aren't grinding higher or aren't pushing themselves higher for Australian meat, anyway, for Australian export beef, that doesn't allow the processor or the exporter to offer higher grid prices to the feedlots. So therein lies the challenge and the issue, where if the feedlot can't get a higher grid price for their fed cattle, they can't offer higher prices for the feeders. And what that does is creates that underlying tension which we're seeing at the minute. The feedlots can only bid markets so high or offer on their grid so much if their profitability is getting stretched as it is. But moving beyond, the current situation, there's two things I'm now, watching that are coming into focus in my view, certainly for the next 6 months for the cows and the next 12 to 18 months, probably at a minimum for the feeders. And I'll start with the cows. If this rain continues for southern Australia and it can get itself sort of back on its feet, the moisture profile can start to fill up a bit and it can find itself in a position for spring. Now, who knows whether that happens or not, but I'm going under the proviso that there is an opportunity it does. What happens to cow supply in southern Australia in spring of this year into summer of 25, 26? Naturally, you're going to expect cow supply to shorten. There's not many cows left down there, as we know, or there won't be by that stage anyway, because the producers will want to retain them to rebuild some numbers. The same thing which I've looked at as well is the demand for heifers. You would expect heifer supply to really shorten up, or availability of heifers on the open market, because of an intention to rebuild. Why I'm talking about all of this is, if the cow supply does stay tight or shortens right up because a rebuild looks to begin in southern Australia, it's going to leave the southern processors, or it's going to force them to have to stay in the northern markets longer than they usually would, simply to access numbers to capture that opportunity. The trim job basically is providing them at the minute. And I think that's something to really consider. And it's something I'll be interested to keep an eye on, because of that short supply, but the demand remaining the same from the processor exporter to actually access those cattle and capitalise on the trim market opportunity that's available at the minute. And it's not going away because of the challenges the US have in terms of, cattle availability, which won't really be realised for another 2 years at a minimum. You can't turn a rebuild on and availability of numbers overnight. The other thing is that reallocation of feedlot space. And this is a probably a longer, 6 to 12 to 18 month view I'm taking. But with the liquidation of the cow herd in the south, the majority of which are British cross cows or Angus cows, what that's going to do for availability of Angus feeder supply in 26 particularly, and potentially into 27, will have an implication on Angus pricing. And my views on that are, I feel like we're going to start to see feedlots reallocate pen space to different categories, be that Queensland crossbred steers, or go into HGP-free heifers, or increase days on feed as a risk mitigation strategy, and limit intakes of cattle to try and deal with this higher Angus market. And I just think that we're going to see some shifts away from Angus into some other feeder types to try and, or for the feedlots to allow themselves to mitigate that risk. And I think it'll be something quite important to keep an eye on. The other aspect to it is, I can foresee feedlots really chasing producers on carcass data and feedlot performance to justify paying the higher price for those cattle. So actually asking producers for kill grids and previous performance of their cattle to justify paying those higher rates. Now, again, when you look at Angus pricing, it will be a cyclical thing, but when you look towards the middle of next year, it will do the same thing. We'll see Angus prices shorten up and come close to evens in spring, summer of 25, 26, and then widen again. But my point is that if feedlots are trying to protect themselves against price risk, they will look to either extend days on feed or reallocate pen space away from Angus into Queensland crossbred cattle or British cross cattle or say an HGP-free heifer. It'll be something quite unique to watch, and we probably haven't dealt with something like this for quite a while, but it'll be it's just my view of where I think things might go. Looking at the MLA's Beef Producer Intention Survey results for the April wave, I'd encourage people to have a look at it. There's some really interesting data in there, and it's a good read. There's a lot of figures. It covers a lot of ground, but it's a really good, I'm not going to call it sense check, but it's a really good piece of information to refer back to. Particularly, you can now start looking at it across multiple years to actually see where producers sit. And in a nutshell, it surveys a couple of thousand producers 3 times a year across all states of all sizes, and ask different questions around sentiment, selling decisions, marketing options, herd size, all sorts of different things. The results themselves, the sentiment in New South Wales and Queensland is by far the most confident. As you'd expect, Vic, SA and WA, the least confident, not unsurprising. But generally, the sentiment at a national level has improved year on year. And I think that, even when you look at those southern states, Vic and SA, their sentiment's still lifted, and they've gone, you could arguably say the last 6 months has been the worst of their drought. So I think that's a positive to see that the southern producers are optimistic. And I spent some time in Colac in early May in the Western Districts, and even the optimism then, and this is just from an anecdotal level, was good, and the data taken around that time, or the survey taken around that time of those producers, backs that up. And I think it's good to see that the sentiment's there, but the optimism clearly by far and away is in New South Wales at a state level in Queensland. Moving past that sentiment situation though, it does ask questions on a producer's intention over the next 12 months to rebuild, maintain herd size, or increase herd size, maintain or decrease. There's clear demand and intention from Northern Australia to increase numbers over the next 12 months. And on top of that, particularly large producers as well. So again, not unsurprising, and something I've sort of been banging on about for a while is that growth in the northern herd and those larger producers where a lot of the cows are carried is there, and this data supports that. Talking of those larger producers, it's funny. It's the opposite to the south. The larger levy payers in the country either want to maintain or increase numbers, and the smaller levy payers in the country have shown a clear preference to maintain or decrease numbers. It's pretty much the opposite, which is interesting to consider when you look at a broad level. The confidence is pretty solid across the board. Another thing which the market sort of knows it anecdotally, but the data again, supports it, and that's that shift towards breeding or focusing more on breeding. But there's two parts to that. Generally, the numbers indicate year on year you've got a bit more breeding focus from producers in general. But the other aspect too is, particularly Queensland as an example, a lot of those producers that breed cattle but also trade, opportunistically has increased. And I don't think that's unsurprising necessarily because of the seasonal conditions they've had up there and are dealing in, so that those good conditions have allowed them to step into some cattle and do a trade which otherwise they wouldn't usually consider. But on the flip side, in the south, you've seen a lean more towards trading cattle. And I think that's got a fair bit to do with cash flow, burning a lot of money, feeding cattle during the drought, buying water, etc. And by the looks of it, the data from the survey indicates that there is a tendency to look more towards trading at the minute for those southern markets. And, if you can get back into the job and get some cash flow turnover happening rather than running into breeding cows where you don't realise any of that potential revenue over a much longer period of time, it does make a fair bit of sense. On the herd numbers, when you look at the data and the change year on year, it's increases across the board, Northern Australia particularly, which again is offsetting the south. And it also supports the intentions for the next 12 months. Now, whether the intentions transpire into actuals is kind of irrelevant, but when you're comparing what they intended to do last year and what's happened this year, the results speak for themselves. I think broadly, it's good to see optimism, and the report. It's pretty clear. Most of the beef sector, when they've sat down to respond to this, or the grass-fed producers anyway, are confident. I think that's great, and that's it's good to see that. But my view still, I suppose they say in financial markets being a bear, but in the sense that I'm a little bit more conservative. My view is we still only have a finite amount of processing and feedlot space in this country, and it's not as if there's big shifts and changes coming that's really going to open that up. And why I say that is because there's a limited resource of both, if seasonal conditions were to turn in any way, the pressure that places on the feedlot and processing supply chain is where I see the risk. That's where the risk lays in this market at the minute. Now, seasonal conditions can change that very quickly and limit that pressure, but that's the risk over the next 6 to 12 months is pressure on the feedlot and processing sector, because it's only a finite resource. I do encourage you to have a read of that Beef Producer Intention Survey. You can find it on MLA's Trends and Analysis website. It's a good read. Contact me if you want to have a chat about it. That'll wrap us up for this week. As I say, questions are always welcomed. So if you've got any and you want something answered on the market like I've spoken about today or in previous episodes, send me an email to ripley.atkinson@stonex.com or record a voice note of yourself, where you're from and the question, and it'll be answered in the next episode. Feel free to share the podcast with any of your mates or any people you know that might be interested in having a listen. More people getting this information and doing what they like with it, the better. It's good to stay informed. Next time, I'm going to do a full rundown on the first half of 2025, how it's shaped up, what have been the key drivers of the market, my views on why things have happened the way they have. And this will precede the release of the StoneX 2025 Australian Cattle Market Outlook for the second half of the year. That'll be released in early July. I'll go into herd size, slaughter, production, live exports, pretty much all your key production figures, my views on what will drive the market for the second half of the year, and those key factors, risks and opportunities contributing to it. But until then, thanks for tuning in. Thanks for your time. Take care, and we'll see you next time. Cheers.